Hello, everybody. Today I want to walk you through something I'm doing separately from my three engine portfolio. So this is a small account challenge that I started with just $3,000, and I'm using it to sell cash secured puts on some individual stocks. So it's kind of a way to for me to generate additional income on the side without touching my core growth income or safety engine allocation. So let's dig in here. So before anything else, I want to be very clear that nothing in this presentation is financial advice. So I'm not a registered investment advisor. Options trading carries real risk. You can lose money and in some scenarios lose more than you even put in. Everything I'm showing reflects my own personal trades in my account. What works for me may not work for you, and past results don't guarantee anything going forward. Please do your own research and talk to a licensed professional before trading options. Now, with that said, let's get into it. So here's where we stand. So I opened up this account a few weeks back with $3,000. And as of today, it's sitting at $2,977.88. So so down about $8 just on the day, which is fine. That's just some normal fluctuation. So I've got $318.88 in buying power, and meaning most of the cash is already spoken for between the two positions here. So these two positions are right here on the table. So we have American Airlines, a $14 cash secured put, and a Ford, $13.50 cash secured put, both expiring in July. American Airlines is in the green, and Ford is currently working against me. So we'll take a look here at both of them in detail. Okay, so the strategy is pretty straightforward. So I find a stock that I genuinely am happy to own, something I would buy, want to buy 100 shares of normally. So that's the part that really matters. Don't buy some meme stock or just some stock that you hear about in some news flash. So then what I do is I sell a put option below the current stock price, kind of out of the money. And so I do that in exchange for taking on the obligation to potentially buy those shares, like 100 shares of it. I collect the cash premium up front. So immediately I get that cash, and that cash is mine regardless of what happens. So the only catch is that I have to hold enough cash in the account to actually buy the shares if I do get assigned. So, and that's what makes it a cash secured. So then that way that I'm not overextended. And then if the stock stays above my strike price by the expiration, the options will expire worthless, and then I'll keep the full premium. And so why do I like this approach? I like this because it generates income on even a small account. And of course, you can see you can scale it up, and you can generate a lot more income if you have more money and more cash secured puts. So this also has a defined and knowable risk, and it works even in a flat or sideways market. So I don't need the stock to go up. I just need it not to fall below my strike price. And so the first trade here is American Airlines. So I did this one at a $14 strike, putting the expiration in July. So I sold this on June 15th for 45 cents per share. So and it's times 100, so that's $45 per contract since a contract covers 100 shares. And then today that option is trading at 41 cents, which means it's cheaper than what I sold it for. So that's good for me as the seller. So I'm up $4 on this position so far. And American Airlines is currently at $15.41. So the stock would have to fall about $1.41 or roughly 9% before I'd be anywhere near assignment risk. So looking at the Greeks here, the delta is 0.2476, meaning there's roughly a 25% probability that this option ends up in the money. The theta, that's the time decay, is a positive at 0.0105, which means every single day that passes up to that expiration date, the option loses a tiny bit of value. And so that decay works in my favor. And this is a position I feel comfortable holding all the way to expiration. Okay. Here we have Ford as my second trade. So this is the Ford Motor Company, which I'm sure you're all familiar with. So this is a $13.50 put, also expiring in July. So this one I sold on June 15th for just 24 cents. So $24 collected up front. So now, sorry. So now Ford has had a rough day today. So it's dropped 3.05% to $13.97. So because of that move, this put option has jumped to 50 cents. So I sold it for 24 cents and now it's worth 50 cents. So I'm currently showing a $26, because it's that 26 cents times 100 shares of unrealized loss on this contract. So Ford is now only 47 cents above my strike price at $13.97. So my strike price is $13.50. So this one is worth, keeping an eye on. So the delta's moved to 0.36, and that's a meaningful increase in assignment probability from when I entered. So I'm not panicking yet, but if Ford continues to fall toward $13.50, I'll have to decide whether to close it out, roll it to lower strike price or further expiration, or take assignment and own those 100 shares. So this is kind of the reality of option selling. So you can win some, lose some, or it depends on how you look at it. You could win either way because you might want to get assigned. So not every trade is going to go your way. And that's why position sizing and having the cash ready matter. So you don't want to, put all your money into this and do hundreds of thousands of dollars unless you have it to spare. Okay, so some risk management rules. So let me share the rules that I'm going to follow to keep this account disciplined. So rule 1 is the most important. I only sell the puts on stocks I'd actually be willing to own. And so I'm sure most of you are familiar with American Airlines and Ford. I wouldn't mind owning 100 shares of either one of those. So if I wouldn't buy the stock anyway, I have no business selling a put on it. And then rule two is always keep the full cash amount set aside. So I never sell uncovered or naked puts. So the cash has to be there. And rule 3 is I limit myself to 2 or 3 options, or actually open positions at a time. Because with only a $3,000 account, I can't afford to spread it too thin and get caught up in a lot of multiple bad positions at once. And then rule 4, I target strikes that are 5 to 15% below the current price. So that gives me a buffer while still collecting a meaningful premium. And then rule 5 is if the trade goes against me, I'll consider rolling it, buying it back, and then selling a new one at a lower strike price or pushing out a later date to give the stock more time to recover. And then rule 6 is I aim for about a 30 to 45 day expiration window. And that way, that's where the theta decay accelerates the most. So this is a premium seller's best friend. So the goals. So actually, before I get into the goals, I'm going to show I'll show my options that I did and show a couple of other examples where you can make a lot of premium if you had a lot more money. But let me do that here next. All right, so this is my American Airlines. So this is where you can see on June 15th, I sold the $14 put to expire on July 24th. And if I can go back here, you can see Ford. I did on June 15th as well to expire on 7/24. And this one was for $24. Now let's take a look at SpaceX, since it's kind of the big one right now. So let's say I want to do a cash secured put on SpaceX. So right now it's at $195.22. So it came out at $135 during their IPO. So let's say I want to do a cash secured put on this one. So if I were to hit trade and then trade options and do the cash secured put, and I want to bring my, the expiration to, this one doesn't have as many. So July is 30. So we'll say 60 days on this one. So we'll go August 21st. And let's say, so it's currently at $195, and I'm comfortable in 65 days buying it at a discount. It's basically, I would, let's say I would pay, I'm willing to pay $195 today, but I'm definitely willing to pay $180. So if in 65 days it drops down to $180, I would have to purchase it, but that would be $18,000. But here you'd see I get $23 premium. So that's 23 times 100. So that would be $2,300 in premium that I would collect today just to buy the rights to buy this at $180. So that would also effectively make that $180. What is that? 158, $157, 60, yeah, $157 a share, because you can minus that premium from there. But that's quite a lot of premium. So let's say I were to do that one. Let's say I were to sell it. You'll see here that my estimated credit would be $2,299. So it's minus the commission or the fees. So that is pretty crazy. $2,300 for 60 days. But there's a lot of stocks out there, and there's a lot of implied volatility. So you'll see here this implied volatility at 94.82. So if it's above 50, there's a lot of people trading it. And you'll see here it's got open interest of 5,500. So there's a lot of folks looking into buying that. So you could actually make a lot of money if you had a lot more money. All right, let me get back to the presentation here. All right, so that was a live example of what you can make on some of these stocks that are kind of with a lot of volatility out there, like SpaceX right now. So if you had that kind of money and you're willing to buy those shares, it might be worth it. Or it might not. It could drop down to zero, and then you lose $18,000 minus that $2,300, so 100 or $15,700 you'd lose. But I don't see that as likely. But who knows? That's just my opinion. Okay, so just real quick here, I want to talk about my goals and my next steps here on this small account where I can afford SpaceX. So where this is headed. So my income target is very modest. I only want to make, or I don't only want to make, but I'd like to make $50 to $100 per month in collected premiums. So on a $3,000 account, that's a reasonable 2 to 3% monthly return. So if things go well. And then the bigger goal is to compound those returns and reinvest the premiums to grow buying power and then scale up over time. And I guess in a long time, I'd be able to afford stocks like SpaceX. So I'd like to see this account reach $5,000 within the next 12 months, just through premium income alone. So on the watch list, I'm continuing to track American Airlines and Ford, plus looking at some other sectors with some elevated implied volatility. So airlines, auto, and similar value-oriented names where the premium is worth the risk. So, and to be clear, so this account is completely separate from my 3-engine portfolio. So with the growth engine, income engine, and safety engine. So those are untouched and separate from this one. So this is purely an add-on and a way to put idle cash to work and learn options trading with a defined and limited amount of money. If you have any questions, please comment below, and we'll see you on the next update.